Good morning, ladies and gentlemen, and welcome to the MITON Global Opportunities PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available on your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Nick Greenwood and Charlotte Cuthbertson, Fund Managers of the MITON Global Opportunities. Good morning.
Good morning.
Morning. Just clicking onto the into the slides. We'll kick off with the team on slide 4. Myself. Been around for many years. I started in the markets in the late 70s. Started doing specialising in investment trusts in the early 90s, and since 95 I've done nothing other than investment trusts. So I'm the sort of the wise end of the team. We also have Charlotte Cuthbertson on the call, who joined me on the fund 3 years ago. Charlotte used to head up our ESG at MITON, and I just felt that having a millennial on the team was incredibly important in such a changing world, and that's proved a perfect decision 3 years on. Just a few words about MIGO before I hand it over to Charlotte. The history is that it did actually start up life in 2004. I was the fund manager at launch, and it started off as a fund of funds. What it evolved into post the global financial crisis is that it's now really a special situations fund. And what we're looking to do is to, I suppose, simply trying to buy stuff at the wrong price. We're simply looking to buy investment trusts where, you know, the shares trade at a big discount, and where, you know, we can see a catalyst for change. And I think just to get to the nub of what we actually do, unlike an open-ended fund like a unit trust or a NOIC, the price you pay for the investment trust is decided purely in the open market. If there are a lot of sellers for any particular reason, the shares can trade at a price way below the value of the underlying portfolio. So we're seeking anomalies in that area, seeking situations where we recognise that the shares are trading on a deep discount, but we can see why that will change. So with that brief introduction, I will pass it over to Charlotte.
Thank you very much, Nick. So I will just take you through the first 2 bullet points on this slide, and then I will pass back over to Nick to conclude the presentation and cover the final point, which is how MIGO is different. And as Nick has explained, what we're looking for is we're looking for these value opportunities. We're looking for trusts where the net asset value, that's the value of the underlying portfolio, whether that's a portfolio of property, whether that's a portfolio of equities or company shares, is the value of that is much higher than the current share price. And this slide just really tries to highlight how we see the investment trust market, what we're looking for, and how we end up with our shortlist for investment. So if I start at the top of the funnel, we're looking for trust trading at a discount. We're looking to be able to buy good assets at a fraction of the price. This means that we tend to specialise in smaller trusts, some of the bigger trusts, which are very well-known names. You'll know them yourself, whether that's F&C or Monks. These trusts tend to trade around the value of the underlying portfolio, whereas we are specialising further down the market cap spectrum. We have to like the asset class. We're not just trying to find discount opportunities. What we're looking for is for that underlying portfolio to be increasing in value, as well as that share price tightening towards the net asset value. So we have to like the asset class. It's not sufficient for us just to be buying trusts on a discount. Myself and Nick's day job, if we move down to having confidence in the NAV, myself and Nick's day job is really lifting the lid of each of these investment trusts and looking through the portfolio of their assets and trying to work out, what we think these assets are likely to be worth in the future and what we believe they are worth now. So we have to have confidence that we understand the underlying assets. Myself and Nick, between the two of us, have been through quite a lot of different and turbulent times in markets. And what we believe is that we describe ourselves as being pretty allergic to leverage, so to debt. We don't mind trusts using a little bit of debt, but we don't like trusts to be over-debted. And finally, there has to be a catalyst. There has to be a reason why and how we can extract that value. And so we end up with a shortlist, and to put it incredibly simply, we're trying to buy £1 worth of assets for as little as 70p. So moving on to why do we have this strategy? Why do we have this mandate? And this really highlights how what we do can create some pretty powerful performance. So this is just a graph of what happens, or what can happen, if you buy trusts on a large discount. You can see the light blue line here is the share price, and the blue line is the net asset value. What we have here, and this goes back to the previous slide when we talk about why we like an asset class, we have that blue line, that dark blue line, going up over time, and that's why we'll have to like the asset class, because we want that dark blue line to be going up as well. And what we have here is the share price going up quite impressively to be matching that dark blue line over time. So there can be reasons why that happens, whether it's the asset class coming back into favor, whether it's the trust has had some strong performance, they've improved the marketing of the trust to garner new investors. But that's what we're looking for. That is the bread and butter of what we're trying to achieve with this fund. So to give you a real life example, this is Ecofin Global Utilities and Infrastructure Trust that we held until earlier this year. As you can see at the beginning of that graph, the gap between the dark blue line, which is the share price, and the orange line, which is the net asset value, was quite wide. What happened with this trust is that the previous management team had run this trust quite poorly. The performance had been pretty poor, and that discount had gapped out. When we bought, there was a new management team had come in. We'd met them quite a few times. We were very happy with how they were running the portfolio, and you can see from the performance of that orange line that they ran the trust very, very well. And because of this performance, because they improved their marketing, that dark blue line eventually met the orange line, and we sold out at the beginning of this year. And you can see how, because we bought it on a discount rather than just buying the value of the portfolio, we bought that share price at a discount. You can see in the top right hand corner that the share price outperformed the NAV performance, and this is what we're looking for. Sometimes how we extract the value in a portfolio is the end of the trust itself. So this is a trust going into realization. So what happens is the shareholders tend to vote for the trust to wind up, and the trust sells off its assets and hands this cash back at net asset value level. We've had quite a few of these in the past in our portfolio, whether it's a takeover or whether it's investors, after a period of underperformance, and what you have in investment trusts is there tends to have been a period of underperformance. Discounts tend to get quite wide as investors sell out of poor performing trusts. So often investors will push some of these underperformers into realization, and therefore you get you get your cash handed back to you at net asset value as they sell off the assets in the portfolio rather than the current share price. So moving on to the next bullet point, a big thing about our trust is how diversified it is. So we have global exposure. We can go into any asset class and into any country as long as it's held in this closed-ended structure, as long as it's held in an investment trust. So we can invest in lots of different asset classes, whether it's equities, private equity, commodities, property. This creates an incredibly diversified portfolio, which does mean that it moves, the trust tends to perform quite differently to mainstream markets and can provide a diversification in people's portfolios. So if I just put this sort of pie chart to sort of highlight the different asset classes that we hold within MIGO. And what we'd ideally like to do is split this pie chart out into each individual theme that we have within the portfolio, but it would be rather difficult, and I don't think our marketing department would be too keen on us for trying. So what I will do is I'll maybe talk through the orange box, which is mining. This is a few of our trusts that are grouped together under the subsection of mining. But what we have here is that actually each of these underlying themes within the mining and within the mining part of the pie chart are actually very, very different, and they move and they perform quite differently from each other, again creating diversification. So if I take the first one, which is royalties, this is a trust that finds interesting prospects, interesting mining prospects, and sells them off to multinationals. As part of this, they tend to get some royalty, which is a percentage of all of the, say, silver out of that mine over the life of the mine. Now, these are incredibly valuable, as you know, a percentage of say, a precious metal that the company is mining can be extremely profitable. Secondly, we invest in a trust that specializes in small cap miners. So miners that are in the small cap area. The growth of passives and ETFs, these tend to favor larger mining companies in order to be able to populate these ETFs, leaving the smaller companies behind. This has meant that smaller mining companies have often lagged in share price terms, and as I mentioned before, investment trusts that are performing poorly tend to see a widening of a discount. From our perspective, we believe that these smaller companies are trading at much too lower levels. These mines will sell out their copper, their silver, their uranium into real world prices, and that dislocation in value should sort itself out. And finally, physical assets. We have a trust that invests in physical uranium. The story here is just one of supply and demand. There's been less and less supply coming online in the uranium market because the price is so low. However, demand is increasing as there are more and more nuclear reactors in the world. What we've seen in places like China and India, where you've had enormous amounts of pollution, they are building more and more nuclear reactors to try and combat this and to move to a more greener energy source. So you've got less supply as mines haven't been finding uranium because the price is so low to justify opening a mine, but you've got increasing demand, and we believe that that's a very attractive story. And one of the reasons that we can create such diversification within the trust is because the investment trust world is becoming a home for alternatives. As you can see on the graph on the left, the issuance into alternative asset classes within the trust world has far outstripped sort of traditional equity funds. And the opportunity here for myself and Nick is that the net asset value for an alternative asset class doesn't necessarily get updated in the same way as with traditional equity funds. So a traditional equity fund would produce a net asset value every day, whereas because it's very expensive and time consuming to value portfolios of property or of timber, this means that you only get an updated net asset value maybe once every 6 months or once every quarter. This means that myself and Nick spend a lot of our day job trying to work out what we believe the underlying assets are worth, and where can we spot some value opportunities where that net asset value is just stale rather than being necessarily wrong. The world can have moved on quite substantially, and that the value of these portfolios can be both lower or higher depending on what's been going on in the market since their last valuation. Sometimes it's that the methodology for valuing these alternative asset classes has become out of sync with the real world or what that portfolio is now doing. So a good example of this is a trust that we have had in the portfolio called Taliesin. This trust specializes in Berlin residential property. We have a surviving trust. This trust was taken out a couple of years ago. But we have a surviving trust called Phoenix Free Deutschland, which does a very similar thing. And the opportunity here is that you have a two-tier market in the Berlin residential market. You have the value of portfolios, value of flats that are in the rental market, which is highly regulated. So unlike somewhere like London, in Berlin, there is this very strict regulation on what you can charge a rental tenant, whereas the value of these flats that are no longer in the rental market have been split up and sold into private hands is much, much higher. And we saw this with Taliesin. Originally, it had been created to be a rental landlord, but was spending much of its time splitting up the apartment blocks that it owned and selling off these into private hands. And therefore, the methodology for valuing the trust used the rental valuation. However, what the trust was doing was selling these flats off into the private market, where the price of these flats was much, much higher. And what we saw in December 2017 is Blackstone also realised that this trust was the value of the underlying portfolio in this trust was much higher than where it traded, and came in and bid for the whole trust. So very interesting story, and this is what myself and Nick do. We look at these various different markets, and we try and work out is there some kind of mismatch in the methodology for valuing them. So I will now pass over to Nick to cover off the final bullet point.
Thank you, Charlotte. Just coming to the final point. MIGO is quite different. The main reason people include it in portfolios is that it moves to its own tune. It's seeking returns from sources very different from other funds. We're looking for pricing anomalies, and therefore, holding in MIGO adds genuine diversification to client portfolios. Just flicking onto the next slide, it shows you the top 12 positions. And you can see here that, despite the big recovery in markets and a lot of these funds seeing their portfolios run quite hard, we're still trading on very, very large discounts. And, it's fairly unusual to see them in the 40s, but, we're at that point in time at the moment where the disruption and dislocation at the smaller end of the trust world is quite noticeable at the moment. And you can see the average discount figure there at 26%. I mean, that is quite unusual. Over the years where we've used similar slides, it's not unusual for the average discount of larger holdings to be close to 15%. So you are literally here buying around 74 pounds worth of assets for 74 pence if a portfolio made up of these positions. So and to remind you that it's important, there is we always there always needs to be a catalyst for why this should change. So I think the main thing that strikes me looking at this slide is that how much our net asset value, i.e. the value of our portfolio, can move just on the narrowing of discount without anything having to go particularly well for the underlying portfolios that we have exposure to, and that's to me is quite a striking slide at the moment to give you the sheer scale of the opportunity that exists just at this moment. Just running through over this year some of the things that have done well or have done badly. Baker Steel is amongst our winners. That was a trust that Charlotte touched on the diversification. It's slightly surprising how well it's done, because what this trust does, it develops and gets permissions on mining prospects and then sells them off to a multinational who then builds the mine. Now, the point at which you get the big uplift in the underlying portfolio is when the permissions are all in place, the feasibility studies have been done, and the project then gets sold off, and then under new ownership becomes an operating mine. Because of COVID, it's been very difficult to do due diligence on a number of their projects. So there's at least 3 of their projects we would expect it to have been sold by now. And it's just very, very difficult. The multinationals don't want to send geologists to places like Zimbabwe because of the amount of time they will lose in going into isolation. So what that will do is going to shunt a lot of these big uplifts into 2021. So actually, the shares have done well. Whilst they're still trading on a reasonable discount, it looks like other people have recognised the pent up rewards that are sort of in the pipeline on this particular trust. Further out, I mean, we won't touch too much on macro in this presentation, but we're in the inflationary camp. A couple of years down the line, Baker Steel has a roughly 40% exposure to precious metals. It has gold mines, silver mines. I think in the longer term that will be quite useful from an asset allocation point of view. Atlantis Japan. It's a hidden. It's one of my secrets. It's been a very strong performing trust, but very few people know of its existence. And here is one where until recently it's traded on an extremely wide discount. Basically, we can see the potential is just purely getting out and marketing the trust to make people aware that it exists. It's a really well run trust. Here, the catalyst for change is just getting the story out there, and that's begun to happen, and it's been a solid performer. And in recent days, unlike elsewhere in the world, Japanese growth stocks have been very, very strong, and this is a trust that has a bias towards small cap growth stocks out in Japan, particularly ones that have a business model that benefit from the rapid change in the demographics in Japan. And finally, amongst the winners, we have EPE Special Opportunities, which is quite an unusual vehicle. Trades at enormous discount, as you will see on the last slide. It's a private equity specialist, but its portfolio has been completely disrupted by Lasico, which has been a small business they created out of a components business in the Midlands. It's now a major manufacturer of LED lighting and electrical components, made in China, distributed around the world. That was floated on the stock market a few years ago, and the stake that it has in Luceco is actually worth more than the market value of the entire company, which, is noticeable because the trust has substantial amounts of cash sitting on its balance sheet. It also owns the vast bulk of Whittards of Chelsea, which carries in its books at a very low valuation. And it also has a stake in a business called Pharmacy to You, which has been a big winner on the move to the net, in the move to get your prescription sent to you rather than wandering around to the chemist. And that's a business that we think, multinationals such as Amazon could be very, very interested in. So those three have led the charge this year. Looking at the weaker situations, interestingly, one of the things we were saying, going through the crash we had this year, is that we struggled to find any permanent destruction of capital, which was certainly not true with the fund in 2008. Yet bounced extremely strongly in 2009. The underlying health of the portfolio seemed to be much stronger than 2008, even despite the fact that we enjoyed a run after that. Probably the only thing that probably is damaged within the portfolio is a small part of real estate investors. Real estate investors is a Birmingham specialist. It's a generalist, so it has offices, it has supermarkets, it has a bit of traditional retail, and probably that traditional retail, despite the fact it will outperform its peers, it doesn't seem to have been affected too much by CVAs. They've done a really good job, but it will have some permanent effect, and that was about 20% of that portfolio. And that's probably the only little corner of the portfolio that we can see that may not bounce back as strongly as the rest of the portfolio. But having said that, with real estate investors, I mean, the net asset value is a good example. It's trading around 60. It's come down quite sharply from 67, and obviously the retail component has done the damage. But the shares are trading at 35, and management seem, reasonably confident of paying a useful dividend. They were paying 4p a year. That's obviously significant relative to where the share price is. It'll be less than that now, but it will certainly be quite significant relative to the share price. And they've recently sold off an Audi. So it's one, you could understand it's small, it's a generalist, and in the property sector, the demand is for pure plays. All of the trusts or property trusts that have a portfolio diversified across a number of different subsectors trade in quite wide discounts. So recognizing it's small, we probably will languish on a discount of around 30% in the longer term. Having said that, 30% of the NAV is 42. That's substantially higher than where the share price is today. So even with this particular situation, there is scope for a rising share price. Duke Royalty is quite unusual. It's basically a lender to businesses, and I suppose it's easier to explain it as corporate mortgages. They'll lend money to a business over a 30-year period. It struggled share price wise over recent months during the crisis because there's been so much bad news in the alternative lending space that it's been tarred with the same brush. And actually, now that the dust is settled, it's had sort of 4 or 5 companies that have deferred interest payments, etc. But Duke have done deals to take 30% of their equity, and I think it does look as though they've played a blinder. But having said that, the shares are still depressed, not as depressed as they were, simply because in the alternative lending space, the peer-to-peer space, which is a different business model, there's been a lot of bad news. Companies have, in that space, have lent money and not got it back from borrowers, even in benign conditions. So it'll be interesting to see what the results are like in that space a year or two hence. And Duke has really struggled share price wise because it has, as I said, it's been tarred with the same brush. Again, sentiment is pretty poor on Macau property opportunities. It owns some very upmarket flats in Macau, which is obviously all about gambling. The casinos have been largely shut now since the early part of 2020. That means the property market is frozen, but it does trade on an enormous discount. All of the concerns are priced in, and that is an important point, that sometimes prices can become overly depressed. The shares are trading at around 70p. I think the last net asset value was somewhere in the region of 190, so an enormous discount. The The company has sold a few flats recently above NAV. It's sold a few parking spaces above NAV. So the transactions that are happening are above the carrying value, which is obviously substantially higher than where the share price is, right? So, hopefully in 2021, casinos will reopen. We have the vaccine, we have the roadmap to where recovery comes from, and the property market in Macau will unfreeze, and the assets, and this trust is in an orderly wind down, so the discount will disappear one way or the other, because as the assets are sold, the cash received is handed back to shareholders. So those are some sort of real examples of what we do. We'll just conclude there. There's a few points. The trust is not particularly correlated to wider markets. As I said before, it's enormously diversified. We can access asset classes from all the way around the world, and increasingly, as Charlotte said, the trust sector, the closed-ended world, is becoming the natural home for alternatives. So a lot of these new asset classes are coming in closed-ended form. So we can get vastly more diversification than you can with an open-ended fund. And final point there, outsourced management solution. I mean, a lot of people can spot the fact there's a lot of disruption, there's a lot of mispricing in this world, but may not have the resources to do it themselves. So it is a great one-stop shop to gain access to this world. And I think at that point, I think the answer is we chuck it over to Q&A.
Thank you very much. Thank you very much indeed, Nick. Thank you, Charlotte. Ladies and gentlemen, do please continue to submit your question using the Q&A tab situated on the right-hand corner of your screen. Just simply type your question and press send. I'd also like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. But lastly, just before I hand back to Nick and Charlotte, I'd like to remind you your feedback is important to the company. And immediately after the presentation has ended, you will be redirected for the opportunity to provide feedback in order that the team can better understand your views and expectations. Nick, Charlotte, perhaps before we look at questions submitted during today's presentation, we've had a number of pre-submitted questions from investors, and perhaps I could start with the first one with you, Nick. You have touched on this slightly, but the question we had in is, why would an investor buy an investment trust over an open-ended vehicle?
Yeah, I mean, over time, investment trusts tend to outperform open-ended. The Cass Business School a couple of years ago came up with a very good bit of research which puts this at about 1%. The reason for that is simply the protection from inflows and outflows. That when we're running an investment trust, we can take a view on a situation. We know that we're going to be able to buy into that situation. We know we're going to be able to hold it in exactly the same way as a private client can, to the moment the most profitable time to sell it. You're not going to have to be forced into the market to meet redemptions at short notice and sell assets at the worst possible time. So, the manager of an investment trust can put in a lot of conviction in their portfolio that you can't do so much on an open-ended. And I think that's simply the biggest difference. What you do have to ask yourself, and in those certain areas, is if you're investing in a large liquid fund of UK equities, for example, you're probably not going to be biased to an investment trust in that point there, because there is less scope for the manager to use the trust sector because he's operating in a liquid market. So I think we'll carry on seeing some of the more traditional trusts that are just long-only equities disappear, as we saw one of the Invesco funds disappear yesterday. But if you're getting involved in mid-caps, small caps, alternative asset classes such as forestry or shipping, you definitely want to be going down the closed-ended route, because the manager can put so much more conviction into their portfolio.
That's great. Thank you very much. The next question we've got here is, how accurate are the NAVs for the various trusts in MIGO, and how do you determine the accuracy? And again, something I think you touched on just on your research.
Yeah, I think in the presentation, Charlotte described that as our day job. Now, on an equity fund, on traditional investment trusts, the NAV is the NAV, just run your Bloomberg, and it's the closing prices of all the listed stocks that you own. As Charlotte said, sometimes methodologies can change and NAVs get stale. So, we'll be looking at the portfolios and trying to come up with a view about where the NAVs actually are. So, good example, real estate investors, the one I spoke about, probably the compared to the stated NAV, you'd expect the real-time NAV to be a penny or two lower than the figure the market is using. But as the example that Charlotte gave on residential property in Berlin, and perfectly sensibly, when the thing was launched, the methodology uses the rental value of a property. But of course, the market has developed. We've had a rent freeze. A lot of landlords are now splitting up properties into individual units and then selling them into the private market, which doesn't suffer from the dead hand of regulation, and those prices are a lot higher. But unless they're actually being sold, the methodology actually just leaves them in as on their retail value. So the true NAV of that particular, German residential property landlord is much higher than the stated NAV. But one of the opportunities is that the market has been so used to investment trusts being equity funds over the years that they treat stated NAVs as verbatim, and therefore the market will base itself on the official NAV. And it doesn't seem as though that many participants have, will make adjustments for what's happened since, or whether the methodology is still appropriate.
That's great, thank you, Nick. And just sort of a bit of a follow-on question, really, here is why are there so often mismatches between share prices and NAVs and investment trusts, and why are discounts so wide at the moment?
I think that the market has become generally the markets have focused on big liquid stocks, and this phenomenon is very much in the medium, smaller size trusts. There's been a focus on liquidity, and therefore a lot of small trusts with maybe a market value of 100 or 200 million have lost their natural buyers. There are always sellers, and the share prices are decided by the balance of supply and demand. And if there's no demand and there's a little bit of selling, then share prices can fall quite a long way. That's
great, thank you. Another pre-submitted question we've got here is, I think probably one to address to Charlotte, and I can see that we've had a few questions come in on the same theme in the live chat, and we'll perhaps wrap those all together. But how activist have you been in the past, and do you think this will increase with greater focus on governance? And Charlotte, perhaps you probably see a few of the questions that have come in live again around that same theme. If you could try and incorporate those in, that'd be really helpful for everyone. Thank you.
Yeah, absolutely. As Nick said, I was head of ESG at Premier or at MITON prior to joining with Nick, so probably a good one for me to answer. We're not ARBs. We're not, we're not arbitrageurs, but we do get involved in some activism with our investee trusts. We tend to find that there are points in the cycle where there is an increased involvement with investment trust boards, and from what we can see at the moment, we believe that we're probably coming into that stage once again, where we will be more and more involved in speaking to boards. What we would say is that not all of our activism is necessarily negative. Sometimes we try and help fund managers and help boards understand the best way of running a smaller investment trust. Frequently managers of investment trusts are very good at investing in their mandate, but not necessarily knowing who to speak to and who to market and how to market. So some of it is, it's positive activism. On the other side, we do get involved in situations where we have to, maybe change a structure or push something into realization. A good example of something that we did earlier this year was we worked with other investors in India Capital Growth. This trust had underperformed the Indian market, and the share price had fallen a very long way, and that discount had widened to at one point being around 40%. This is obviously not great for the trust shareholders. What we did is we spoke to the board and worked with them to create a new structure for this trust. So instead of the trust being what we call an evergreen structure, so just continuing each year as it is, this trust now has a realization option next year where investors can get out at around 6%, a 6% discount, which which has helped tighten that discount since this was put in place. So we do, activism. What we say is, it's a tool in the box, it's a string in the bow, but it's not it's not our primary thing that we do. What I would say is that you've got an increasing focus on ESG and especially on governance, and that's the side that myself and Nick particularly look at. So in the past, perhaps boards could get away with sort of sticking their head in the sand and not listening to and engaging with investors. It's probably just not really the case anymore. There is much more scrutiny on board members and their ability to listen and to respond to shareholders. So I think we are moving in the right direction in that side of things.
That's great. Thank you very much, Charlotte. I think you've both kind of touched on the next question in a number of the examples, but how's the pandemic affected the portfolio and what's your outlook for the future? If there's any further colour you guys can perhaps add to that.
Yeah, I mean, we didn't really have any, as I said, we didn't really have any exposure to the sectors that were hit hard. So year to date, the fund is up a bit. Difficult to believe given where we were in March, April. I think outlook roadmap from where we are here. We have the vaccine in place, and therefore probably relatively quickly, given the news flow on vaccines is speeding up. In that, by the time we get into the early months of 2021, the economy hopefully will be genuinely picking up. But at the time, we have enormous amounts of stimulus in the system. So we've stayed long, we've stayed fully invested because we can see this sugar rush developing. Counterintuitive at a time when the real world is having a tough time. The stock market is going up pretty much every day. But it is logical if you think of the sheer size of the sum that are sloshing around the financial system that have been put in there to oil the wheels to prevent slumping into an enormous recession. Inevitably, when you have that cash sloshing around, it ends up in asset prices, and we're seeing house prices going up. We're obviously seeing equity prices going up. But it is a case of, I sort of liken our situation as sort of sitting with your foot hard down on the accelerator, with your finger hovering over the ejector seat button. There are some severe problems coming in the pipeline in the medium and longer distance, and we've not used it in presentations, but with the 2.1 trillion that the government had borrowed prior to the latest rescue packages, and divide that by the working population of 32 million, you would come up to a figure of 600 or 1,000 for every taxpayer. Not sure whether that's accurate or not, but what I am pretty sure is that's an enormous number that can't ever be paid off, and therefore maybe it will be inflated away and all that. But there's always a time lag, and therefore the time lag, typically 18 months to 2 years. So the real problems are probably much further out.
That's great and fantastic analogy, Nick. I like that. Next one we've got here, how's market liquidity fared over the last few years, and particularly through the pandemic, and how have you coped with this?
It's become ever more difficult at the very smaller end, and I think that's due to structural change. I don't think there's anything really to do with the pandemic apart from temporary. I think that we've seen an enormous consolidation of fund management groups and wealth managers becoming mega chains who are running vast pots of money, and they can't buy a £500 million investment trust because it just wouldn't move the needle on the portfolios they're running. So we're seeing increased focus on large and very large companies away from mid and small caps. So liquidity has become tougher. Ironically, of course, what that does is, because we're an investment trust, because we're closed-ended, we can actually take the conviction that a lot of investors who would have been fairly active in this area can't get involved in because they're just now running too much money. So we are sort of getting the field to ourselves to exploit, and therefore, in a funny sort of way, for my go, it's incredibly positive, but maybe not so positive for the investment trust world as a whole.
Great, thanks, Nick. next one we've got here is, could you elaborate on the performance of the trust over the last 5, 3 and 1 years? And I think actually probably more one for you, Charlotte.
Yeah, absolutely. So MIGO's benchmark is SONIA, which is the Sterling Overnight Index Average. That is plus 2%. And why this was chosen was because it's sort of a good gauge of how cash would perform. And the reason that we have a cash sort of benchmark was when this trust was set up, we didn't want to be tied to benchmarks. We wanted to be able to sort of go anywhere and do anything and exploit the opportunities that we saw, rather than needing to be hemmed in by too much of a benchmark. So we have a cash benchmark, but we do also look at how we performed against mainstream indices. Over 5 years, the trust has performed very, very well. I think I have some numbers here. Performed very, very well. So it's around 70% over 5 years. That's in comparison to the SONIA, which is just over 2. Adding the 2% that is our benchmark is around 4. So comfortably outperforming cash. Over that time, if we want to look at more of a mainstream benchmark, the FTSE All Share is up around 22%. So again, comfortably outperforming over the long term. The 1 and 3 year numbers are not as good. The 1 year number we're up about 1.5%, and over 3 years we're down nearly 4%. And what we find with this trust is, because we're buying deeply discounted investment trusts, and we're waiting for that catalyst that we've identified to come to fruition, we do find that there are quite explosive moments of performance, explosive years of performance, and then as we sort of recycle the cash out of the trusts that have done very well and into other trusts, there tends to be some quite quiet years. So over 1 and 3 years, the SONIA has been 0.24 and 1.5 over 3 years. Over 1 year, we comfortably outperformed the FTSE All Share, which is down just over 10%. And over 3 years, it's down nearly 2%. So, it is very difficult to find a real benchmark, because, as Nick said, we are looking in a very, very different area of the market to mainstream indices, and the fund and the trust does tend to perform very, very differently. But over that longer term, I think we've shown that this can be a very, very profitable strategy.
Sorry, the last one we've got here is, who are your main competitors or peers in the market?
Well, we don't really have any direct competitors. I suppose there are a couple of hedge funds in the States that look at this area. I suppose you've got City of London, who more focus on emerging market trusts. Unicorn have got an open-ended fund that gets involved in investment trusts, but more focused on asset allocation there. So regarding special situations in the closed-ended world, we are unique, really. So there's no direct competition, but for those 4 or 5 people I mentioned, we might compete for trades. We might have an idea, and they might also, it might fit into what they're doing, and therefore they might be buying the same sort of stocks as us. But as a product, as the sort of returns that we're seeking, it is unique, and that's part of the reason why it tends to move to its own tune. As Charlotte was talking about performance, if you look at it, there are periods where we're not just top quartile, we're number 1, and then other periods where the things, the thing's been gloriously unchanged every day for about a year, and it's very quiet. So that sort of, the fact there isn't anyone else doing exactly what we do, it means that we are we're doing something very different in performance terms from most mainstream funds.
That's great. Thank you very much indeed. And I appreciate perhaps you haven't had a huge amount of time to look at some of the questions that we've had come in, and I can can see a few of those we've, I think, covered off in some of the pre-submitted questions as well. But perhaps I could just hand back to you, Charlotte, just to run through some of the questions that you can answer there. Just read out who they're from and the question. That'd be fantastic.
Yeah, no problem. So we've had a question from Abby R. With so many trusts, how do you manage your focus and what levels of research do you undertake on a new holding?
Is that one for me, Charlotte?
Yeah, sorry. Yes, I was leaving it up to you.
I was waiting for you to I suppose what happens is we spend a lot of time talking to people, looking at situations. I think I used to be a broker many years ago, and the problem with being a broker, you have to know a little bit about everything. When you're sort of focusing on investment opportunities here, you end up knowing a lot about a little. So the things we follow in quite a lot of depth, and the things that we're looking at. There's always sort of half a dozen new situations in the pipeline that we're working on. So part of the focus is not to spread yourself too thinly, to really focus on the situations that you're looking at day to day. But it does mean today you do have to sort of know quite a bit about a lot of asset classes. We're looking at shipping, for example, in detail at the moment, which is a whole new world. And it's been quite helpful talking to people who've been bankers in that sector and based in Hamburg about what really happens in shipping. So yeah, quite a lot of focus on what we actually own and what we might own, and then a lot of the more liquid stocks. We don't spend much time, shall we say, analysing a Scottish mortgage because it's not overlooked and it's not unloved. So yeah, focus on the situations that we actually hold.
We've had another question in from Andy C. Are there portfolio differences with the open-ended fund, and if so, what and why? I think I can probably take this one. So we do have an open-ended fund that is run in a very similar way to the investment trust. The difference between the two funds, as Nick has sort of talked about why trusts tend to outperform, is that with an open-ended fund, you do have to focus much more on liquidity. So to give you some examples, some of the trusts that we have in MIGO, that we have very large positions in, are much smaller in weighting in the open-ended, because we have a focus on liquidity and we need to be able to sell that, or to adapt these positions depending on the inflows and outflows into the open-ended. So the mandate is the same, the theory is the same, most of the holdings are very similar. We do have more holdings in the open-ended, again, for liquidity. But in the investment trust, because we're protected from inflows and outflows, we are able to take more conviction positions. So that's the difference between the two funds. I think we have covered a couple of these, which were regarding activism and governance. We have a question from Reginald H. Are you still a holder of Polo Resources? Nick?
No, we've it's not one we've owned. Polo Resources, did you say?
Polo Resources, yeah.
Yeah. No, not one that we've looked at in any detail, I'm afraid.
No. And that looks to be the last of the submitted Q&A.
Thank you very much. And if there are further questions, do please submit them through, because the team will be able to review them post-event. And I think you have, as I say, covered those off. So thank you very much indeed for that. Just before we go to redirect investors for some feedback for you guys, Nick, perhaps I could just ask you to wrap up with a few final words for investors, please.
Yeah, I think we've been able to give you a flavour. It is quite different. Nothing's complicated. There's just a lot of it. It boils down to the fact that it's a very inefficient market, and it does give you opportunities when things are either out of favour or there's a big seller around to buy perfectly good assets at completely the wrong price. And it's basically as simple as that. Yeah, it's your one-stop shop for getting exposure to this phenomenon, really, as we spend sort of 100% of our time dealing with it and perhaps understanding the ins and outs of the market, having, in my case anyway, lived in this market for a quarter of a century. So yeah, we'll leave it there, and hopefully we'll do this again at some point in the future, and maybe take you a little bit further into the details.
That would be great, and thank you again. So thank you very much, Nick. Thank you, Charlotte, for updating investors today. Could I ask investors not to close the session? You will be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear directly in front of you. If you've accessed it via the email and the link, you'll be asked to log in and submit your feedback, which takes just a couple of seconds and will be much appreciated by the team. So on behalf of MITON Global Opportunities PLC, an Investor Meet company, we'd like to thank you for attending today's presentation. That concludes today's event. Good morning to you all.